So, ladies and gentlemen, good evening. Welcome to lesson 2. On the first lesson, just a quick refresher, we went on to learn IFRS. Wait, hang on. We went on to learn your framework. Then, on the framework, there was 7 chapters in your FR. So, the first chapter, we learned what are the decisions of framework. Chapter 2, what are the characteristics, qualitative, enhancing fundamental, qualitative characteristics. Chapter 3, you learn going concern. Chapter 4, you learn to define an asset. Chapter 5, recognizes. If you no longer meet the definition of an asset, liability, equity, you go and derecognize. So chapter 6, measure. Chapter number 7 will go and disclose. So this is, we still continuing the framework. And on the last lesson, which was earlier this week, Monday, we had finished question 4. And you had gone home and tried question 5, right? Okay. So let's try question 5. Which of the following is not a purpose? A purpose means the aim. Okay, if you go back to my lesson 1, remember after every lesson, I will actually update by uploading for you. So here was lesson 1. So sorry, chapter 1, also lesson 1. The objective, the purpose or the aim of the RASB is to show accounting standards that's consistent, to help preparers and users to make decisions. Therefore, we now come back and look at the question is asking for not a purpose. So what do you write there? Is this an aim of the framework? What I say, is this an aim of the framework? I'm looking for no. It is not an aim of the framework. To assist, definitely it is an aim. We saw this since the lesson 1. So this is actually correct. Just a moment. And then B, to assist the auditors. Auditors are the preparers, including accountants. Yes, this is also the aim. If you're not sure, you can stop me and you can chat. I'll be able to reply you to assist in determine item. What kind of item? Such as the cryptocurrency. There is no accounting standard on cryptocurrency. Therefore, this you follow the framework. When you have an item that is not covered by any accounting standards, yes, you go back to the framework. So by deduction analysis, if A, B, and C are not the answer, then D must be the answer, right? But why? Because it is not authoritative. Last lesson, I talked about a rule-based and a principle-based standard. If you have IFRSs, they are not the same as US GAAP. Where's that page? US GAAP shows you that they are rule-based standard. So we have this page number 6 from last week. US GAAP, generally accepted accounting principles are rule-based. The IASB rights principle-based. Therefore, let's come back to the answer. It is not authoritative. Authoritative means it is rule-based. So D is correct because it's not the purpose. The IASB framework, it is principle based and it is not authoritative. Authoritative rule based. Is it? No, it is not. So the answer is D. If you have gotten the answer correct when you practice this at home, congratulations. If you did not get this correct, I hope you understand what had gone wrong. Next one is question 6. The framework has a faithful representation. Okay, let's go back to last lesson 1. On the framework, it is on chapter number 2 that says you must present using substance over form. So this is called faithful representation. Let's see what question 6 is asking. So question 6 is asking, which of the following are correct in the principle of faithful representation? So what's the keyword? Correct. Therefore, correct and faithful representation. This is 2 keywords. They're asking which is correct. Question mark. Reporting a transaction on the legal status, unfortunately, is wrong. You should report on the economic substance rather than the legal form. So this is switch over. This is a switch over. So sorry, it is incorrect. Next one, for B, it says to exclude a subsidiary from consolidation when the activities are not compatible. No. As long as you have a subsidiary, even if it's in a different industry, uncompatible activities means different industry, you have to consolidate because a subsidiary exists. We say a parent company, they must consolidate. A parent company must consolidate its subsidiary. And even if it's in a different industry. So if you have a service company and a manufacturing company, but they're a parent and subsidiary relationship, you have to consolidate them. If you just join us, good evening. We are now on question number 6, part C. To record the whole of the proceeds of a loan issue, which is potentially convertible as only debt. I'm so sorry, that is not true. Let me show you very soon. You will be learning chapter number 4. And in chapter number 4, this is IAS 32. On IAS 32, which is on page number 118, this is a convertible debt. In a convertible debt, you have to split to both a liability and equity. So you have to split to both debt and equity. Not debt only, not equity only, which page 118. So I say, let's go and see page 118. In the near future, you will learn IAS 32 shall apply split accounting. A convertible debt into both debt as well as equity. Not debt only, also not equity only. So the whole as a debt, it is wrong. The whole thing as a debt is wrong. And as a result, it must be both debt and equity. What do you call that? Split accounting. Clear? So A, B, C are all incorrect. The only possible answer have to be D, Y. It says that I must allocate, I must share part of the sales proceeds of a motor vehicle to interest received, even if it's zero interest. What's that? You sell me a vehicle and you charge me interest free. But why must you recognize interest income despite it is 0% interest free? Well, this is where you still apply the same IAS 32 to record at the shall record at the market interest rate. You call this mark to market. The market interest rate, despite it is 0% interest. So how much is the nominal interest, which is 0%, or any other percentages? We don't care, because you shall always mark to market. Next one, a little bit of calculation. Still on page 21, but question number 7. Last week, no, on Monday, this week, we also learned your chapter 6 of the framework. So I try to relate to the knowledge. Last lesson, Monday earlier this week, we learned chapter 6, which is called measurement. There's this current value. There's also this historical cost. So how would you answer question number 7 using historical cost and current value? We come back. This question is asking, find, please, the net book value, the carrying amount or the carrying value. I will take the cost, can be historical cost, can be current cost. So it can be a HC, it can be a CC. So generally, I call it a cost minus ACC, accumulated depreciation. All right, then I get myself a carrying value, carrying amount, or a net book value. It's the same thing. So your year end is now at September 2014. On October 2012, you bought an asset. This asset is known as the historical cost. So this is what we call 2 years ago. 2 years ago. What is it for? Accumulated depreciation must be 2 years. Then, let me just... Here. Residual value is 10% of the historical cost or the current cost. So how does it work? Very simple. You are now going to measure cost. This is under the historical cost of $500,000, right? And you minus away the accumulated depreciation. How much is the accumulated depreciation? The cost minus 10% squared. Residual value is only 90%. And life is 5 years. Accumulated depreciation for 2 years. Let me show you. I think I need more space. Okay, let me push it a little bit lower. Then, let me show you. Accumulated depreciation. I take the same historical cost. I minus a 10% residual value. 10% of $500,000, it is 50,000. I divide by the remaining useful life of 5 years. And 2 years ago, I will multiply by 2 years of accumulated depreciation. So 450 divided by 5 times 2. Very good. Thank you very much for your help, Lai Hong. Thank you, thank you. So this is your carrying amounts. Well done. And cost minus 180. Very good. Lai Hong has provided the answer. So we take 500 minus 180, 320. Therefore, the possible answer is either A or B, not C, not D. Then, we're also given the current price, current cost, current price of 600. Everything else is the same. CC stands for current cost, 600,000 minus away 2 years of the accumulated depreciation. Here is 600 minus 10% residual value is 60,000. Life, 5 years. And you have 2 years here. This will give you 384,000. Answer is B. So if you have done this at home and you found the answer to be B, congratulations. All right. If you have just joined us, turn please to page number 22. This is theory. Try. I'm not sure if you have read it before, but if you have not yet read it before, read it now. Point A. Substance of form would be an example. So is this to charge rental to the P&L when it meets the criteria of an asset? The keyword is, since it is an asset, you cannot charge it to the P&L. You shall capitalize it even if you do not own it. Therefore, charging to the P&L is wrong because it meets the criteria of an asset. So, since the amount met the definition of an asset, you shall recognize as assets. What does that mean? It cannot charge to the P and L, which is wrong. So A is out. How about B? You cannot go wrong with B. Earlier, what did we see? We saw on page 138, if it's a convertible bond, it is a debt now, that in the future it may be converted to a ordinary share. So you cannot call it an equity or a debt at the point it's issued. But instead, you have to call it both debt and equity. So you shall classify split accounting, a convertible bond, as both debt as well as equity. Not debt only, not equity only. It has to be both. So the words that says equity only is wrong. Next one. Last lesson I also show you that there's a bank called OCBC. This OCBC is a bank in Singapore that have a redeemable preference share. Redeemable preference share. So if you have a redeemable preference share on the screen, you shall classify in substance over form. Because the keyword is redeemable, it means it is repayable. And if it's repayable, it cannot be shown as equity. Equity is wrong. So you shall classify as debt or liability. Why? Because redeemable means it is repayable. Last one, it is correct to de-recognize a trade receivable without recourse, remove. Let me just show you. There's this page 1.3.1.4 something. Give me a moment, please. That substance over form, chapter 5. You see, in chapter 5, substance over form, there's this called debt factoring. It should be on page 142. 142. This is page 142. What's called debt factoring? You sell your accounts receivable. When you sell your accounts receivable without recourse, on page 142, without recourse, you shall remove your accounts receivable. So without recourse, remove accounts receivable. Right? Do you see that? Good. So page 142, let's write it down, please. On page number 142, chapter 5, substance over form. Without recourse, you sell a debtor, is called factor. To factor means you sell a debtor. If you sell it without recourse, it is called factor without recourse. You shall remove accounts receivable. Right? To de-recognize is correct. So the keyword to remove a receivable is to de-recognize is totally correct. Yep. Okay. So if you have actually done this correctly, good. If you have not done it correctly, you can ask me questions. Otherwise, take a moment to look at question number 9. So what's question 9 asking? Question 9 is asking, in an emerging market where price rises frequently. One word, it is called inflation. Price rises quickly, inflation. Which of the following is true? When you're using historical cost compared to the current cost in this inflation. Okay, what's the keyword? Historical cost, current value. That means to say, during inflation, you will have a low historical cost on the asset, right? And you will have a high current cost. Current cost, current value, because due to higher prices. The question is asking you which is true. So inflation, true or not? 1. Ratios. Capital employed. The formula for capital employed, CE, is for you to take non-current asset plus current asset minus current liability. This is one way. There's also another way, or capital employed is equals to non-current liability plus equity. So these two ways are correct to find capital employed. Using historical cost is understated compared to carrying value. Is it true? Of course. It's true because when you have low historical cost, you also have low non-current asset, or you have low equity because there's no revaluation reserves. Therefore, low capital employed. If you have a revaluation reserve, equity is high. But there isn't a revaluation reserve, so low equity is correct. Got that? So this is a true yes. Sentence 2, question 9. If you have joined us now, page 22. Page 22, question 9, sentence 2. Historical cost profit are too much compared to the current cost profit. Is it true? Well, let's take a look. In a historical cost, what do I have? I have low non-current asset. If I have low non-current asset, I charge low depreciation. If I have low depreciation, it will result in high profit compared to a current cost. So do you think this sentence is true? Definitely, it is true. Make sense to you? Next one. Capital employed cannot be overstated if you tell me that understated is correct. So if you say understated is correct, then this one cannot be overstated because it's the opposite. Mutually exclusive, it's just the opposite. So sentence 4 is also the opposite from sentence 3. If you say that the historical cost profit is overstated, obviously it cannot be understated. It is another no. So for this, answer is A. All right, so take a moment to look at this question 5, 6, 7, 8, and 9 that we discussed tonight. Is there any questions that you'd like to ask me? If yes, don't be shy. You can unmute yourself, can speak. You can also chat. I'll be able to read your chats. Thank you. If you have no questions, we have more questions and answers at the back. So these are questions and answers. So please take some time, not now, but when you're revising, to read. Why? Framework is the fundamental basic of many accounting standards. So it is good that you understand the framework. Next, turn and you have IFRS 18. Ladies and gentlemen, this is very, very new. When they say IFRS 18, we tick. There are altogether 29 accounting standards in your financial reporting. This paper, 29. We have finished first framework. Now another standard. This is very, very new. All right, very, very new. On the IFRS organization, let me quickly show you. This is your IFRS. And then on your accounting standards, you have IFRS 18 on the screen. You see IFRS 18 here on the screen, this one. IFRS 18. It is the youngest accounting standard. So what you're learning is not company application yet, because IFRS 18 is only applicable on 1st of January 2027 onwards. So is it applicable today? Not yet. Although early application is encouraged. But if you don't apply this, it is still fine. Right? So IFRS 18 have superseded. Some new word for you, right? Have superseded. Another name for superseded means it has replaced the old IAS 1. No more IAS 1. It is now being taken over and then replaced by IFRS 18. So what does it do? It shows us how to present financial statement. Are you ready? How financial statement is presented. So let's come back here. A full set of financial statement. I'm on page number 24. Ready? Good. So let's come back and look here. When we write FS, FS stands for financial statement. They now include your SOPL and the other comprehensive income. Point A. Point B includes your statement of financial position, which is called the balance sheets. In the IAS 1, they remove the name balance sheet, but it is not wrong to still call it balance sheet. In your C, statement of changes in equity, statement of cash flow. Now this is a bit interesting because A, B, C, these are on accrual basis. You apply the matching principle, you apply the accrual basis. I recognize income when earned, not when cash is received. I recognize expenses when paid, not when, let me rephrase, I recognize expenses when incurred, not when cash is paid. However, I have a D is your cash basis. I only recognize when cash is received and paid, not on accrual basis. This is IAS 7. Then you have a note to the financial statement. This is your disclosure. You have a comparative. You compare 2 years. You compare 2 years. this year, last year. But sometimes you may also compare 3 years. Sometimes you may also compare 3 years. So students say, I don't understand. Why do you say sometimes we compare 2 years? Why do you say sometimes we compare 3 years? Just a moment, let me find my good friend. Who's my good friend? Far East Orchard Limited is my good friend, which is the one I uploaded. So in Far East Orchard, this is your balance sheets. As you can see, your balance sheets. How many years do you have? 2. All right. This is your financial statement. There's 2 years. But there are also an occasion whereby you reported 3 years. I hope I find the right annual report. Just wait a while, please. No, this is still 2 years. So 2 years is wrong. That means it's 2018. Let me try 2018. So this is the annual report of Far East Orchard 2018, as you can see. Let me try to find you the balance sheet. There. Do you see how many years? On the balance sheet, 3 years. The opening of 2017. So this is called the opening balances, as well as 2 years to compare. So 2 years plus an opening. Maybe I can update the materials to say it is actually 2 years plus an opening balance. All right. So what do we have here is your Far East Orchard for the year ended 2018. How many years of comparative? 2 years comparative. 1 year opening balances. Why? Because you have an accounting standard that requires you to show 3 years. So I hope that this helps you in your understanding. All right? Not sure, you stop me. So together, we call this financial statement. Now you look at P&L. Ready? SOPL shall report the maybe loss, maybe profit after tax, PAT. So you call this a profit after tax, PAT. You classify as that this is your investing activity. You buy associate joint venture subsidiary. You call it financing, your interest income, interest expenses. Then you call it taxes. You call it discontinued operation. So if it is not B, C, D, E, it must be A. So this A is good. Why? Because we call this a catch-all. Catch-all definition. What is a catch-all definition? Any expenses that is not B, C, D, E, it must be A, so that no expenses escape. What does this mean? If any baby that is born, there's not a baby girl, must be a baby boy, vice versa. It catches all the babies because there's no third gender in between, don't have. See the point? Same concept. Then you have your other comprehensive income. In your FR, financial reporting, right, only includes 2 things. One, your revaluation up, revaluation down, revaluation reserves up and down for the whole year, RR, And also, number two, your financial asset at fair value to OCI. Only these two. The rest you don't have. Only these two. Next one, your statement of financial position, SOFP, follows your asset, current, non-current, liability, current, non-current, and then the differences is called equity. Right? Next one, on page 26. This is how statements of profit and loss account look like. So first of all, we have this stretch. This stretch. What's so special about this stretch? This stretch here is your SOPL shall report your profit after tax. When I say profit before tax minus tax, I get profit after tax. So what's the big deal? PAT in the SOPL, they must go to the retained earning on the balance sheets. So which one comes first? I am an accountant. I'm not a scientist. Scientists can tell you whether the chicken comes first or the egg comes first. But if there's no chicken, where's the egg from? I don't know. Because scientists answers that question. I'm an accountant. I answer you, PAT comes first. Then the retained earnings will come. So this is the differences, right? Okay, finish it. Here is your profit after tax attributable. Attributable means there's a parent share the subsidiary's profit, and then the shareholder, the NCI, are also shareholder of the subsidiary. The subsidiary profit go to two people. They go to the parent, they go to the NCI. So this is under IFRS 3 that you will learn not so soon, but I think lesson maybe 15, 14, about 14 onwards, then you'll learn console, but not so soon, yeah? So this is your earnings per share. Earnings per share. IAS 33. You must report in cent. The top you report in thousands of dollars. So what did I say? You reported in thousands of dollars. So it's called in thousands of dollars. Do you see? Thousands of cash unit. CU means cash unit or currency unit. Can be dollar, can be euros, can be KMR. It doesn't matter. Right? Can be KMR real. So it's called CU means currency unit. The rest, this one must be in cent. Earnings per share in cent. Not in thousands of dollars. This is in cents. Clear? Some more. Your OCI. So this is your other comprehensive income. You call this the OCI. In your FR syllabus, you only learn revaluation. You only learn fair value to OCI. So the rest you don't care. You ignore plan benefit, associates, translation, all this you don't care. Until you come to my SBR, then you care. But in the meantime, you only have these two in your financial reporting syllabus. Not done yet. This parent and subsidiary, it is still your IFRS 3. IFRS 3. So far clear? So what is IFRS 18 about? The way you show, the way you present. It do not teach you the way to calculate. For example, if I'm not sure, you have revenue. Let's not go too far. Let us look at this called revenue. Ready? How do you understand this? You apply IFRS 18 in order to present what? Revenue in the statements of profit and loss account. How to calculate? You separately apply IFRS number 15, revenue, in order to measure, to calculate, to measure revenue. So you need to know what's the differences. You are now learning IFRS 18. 18 is about how you present. Does it teach you how to calculate? No, I'm so sorry, it will not teach you how to calculate. It doesn't. But IFRS 18 will teach you how to present, how it look like. You want to learn how to measure, you come to IFRS 15, you measure revenue. You come to IAS 16 to measure property, plant, equipment. So you need to know what you are learning. So this is your SOFP. All right. So let's come back to here. This is your non-current asset, followed by current asset. I know that the Fives Orchard shows the other opposite. Fives Orchard balance sheet show non-current, show current first, followed by non-current. Please don't follow. But ACCA, or which is based on your financial reporting, right? We present non-current asset first, current total asset. I'm not saying that Far East is wrong. They show asset minus liability, show net asset. That is equity, you got total equity and it balances up. It's very different. I'm not saying that they are wrong. PricewaterhouseCoopers are not wrong. It's just we show using non-current asset first, followed by current. Then you show a total asset, equity plus liabilities. You get total asset, balance up equity plus liability. You follow the accounting equation of asset is equals to equity plus liability, the accounting equation. Now you have a special, in fact, two special account called retained earning, as well as OCE. What did I say just now? If I have a profit after tax, it goes to the retained earning of the balance sheets. If I have a other comprehensive income, it will OCI will go to the OCE. What's the differences? OCI stands for other comprehensive income. OCE stands for other components of equity, and they're not the same thing. Very different. So now, I was jokingly saying, I am not a scientist, and I do not know whether the chicken comes first or the egg comes first. But I'm an accountant. I will always know that first, I will have the profit and loss account that gives me the profit after tax. Then I have the statement of financial position called the balance sheets. And it will give me, what happened? It will give me the retained earning. So what first? The PAT first, then the retained earning next. You ready? What first? The OCI inside the OCI first. That means in the P&L, below they got OCI. Then you have the OCE, other components of equity. Please do not get confused between OCI and OCE. OCI comes from the P&L, they call it other comprehensive income. You have the OCE, is called the other components of equity. In your FR syllabus, revaluation reserve, revaluation surplus, you know, financial asset, you know, share option, currency exchange, cash flow hedge. So these are just some examples, but you concentrate on revaluation reserve and financial asset. Okay? Then, this is your NCI, which is based on IFRS 3. So the rest is quite current, non-current liability, quite straightforward. So this is just something new that you have retained earning and other components of equity, just called other reserves. All right, so now I'm on page number 29. The statement of changes in equity will report quite a few things. This is called retained earning. Revaluation reserve can also be called revaluation surplus or the word reserve. You can call this RR. All right, so this is in your financial asset at fair value to OCI. Let me write it down again. Financial asset at fair value to OCI. You got that? Okay. So from balance on 1st of January, you can have the adjusted balance. What's this? Be careful. This is called the unadjusted. Unadjusted. On the unadjusted, it is called January the 1st. Until the adjusted, it is also called January the 1st. So altogether, you apply, this is known as IAS 8. This 400 here is known as a retrospective adjustment. What's called retrospective adjustment? You adjust this year as if it was adjusted last year. So you change the comparative and you change the opening retained earning. All right, so if you're not sure, don't worry, you just need to show the presentation. Next, you get the end of the year. Remember, when you adjust it retrospectively, from the opening balance, it becomes the opening balance. You cannot suddenly adjust to become the closing balance. It doesn't work that way. Next, what do you have here is this one. You IAS 16. You will debit RR, reduce your RR. You will credit your RE. When you debit RR, you reduce your revaluation reserves. When you credit RE, you increase, you plus the retained earnings. Are they the same thing? No. So we call this a transfer from R to RE. I'll teach you this in IAS 16. So like I say, IFRS 18, take note, IFRS 18 teach you how to present the financial statement, but they don't teach you how to measure. No, they don't. Whereas individual standards like IAS 16, they teach you how to measure your revaluation reserves. Okay, it's not just revaluation reserve. Let me be more precise. Property, plant, equipment, and also your revaluation reserves. So you have to be very careful. What you are learning now, it is the way to present. It is not the way to measure. So, ladies and gentlemen, any questions as of now? No? I spent almost an hour to finish question 5, 6, 7, 8, 9. 5 multiple choice question. And then I talk about some theory for your framework that you can read. And obviously, I finished the next standard called IFRS 18. So you cannot practice any past exam question yet because it's just the way to present. So IFRS 18, nothing to be stressed. It's just the way to present. Then you have another standard to learn with me that is called the IFRS S1. Look at the bottom of the page. You have a S1. It's about sustainability. Ladies and gentlemen, where are you now? You are here on page number 30. 30. If you visit World Wide Web, IFRS organization, you will go to ISSB and they have IFRS S1 under sustainability. Something new. Sustainability. So if you have any questions about any standards earlier, you stop me. Otherwise, we are learning something new. It's called sustainability. So let me minimize the chat box and I show you this. It's called World Wide Web, IFRS.organization. Do you see sustainability? Now, do you know who is the ISSB? International Sustainability Standards Board. They have 2 sustainability disclosure standards. In SBR, students must learn both S1 and S2. But you are studying FR, you only learn S1, but you don't learn S2. Now we go back. So that if you are curious and you wish to know who writes the sustainability standard, the answer is very clear. It is by the ISSB. What do you report? You shall apply IFRS S1 to disclose anything that is good news and bad news, your risk and opportunity, risk and opportunity. So what's that mean? IFRS S1 shall disclose both good news. Good news are called opportunities, as well as bad news. Bad news are called risks. Opportunities and risks. All right, that's what you do. So if you are done, you notice that unlike your sustainability, unlike your IFRS 18, which is 2027, this is already applied in 2024. So companies in Cambodia, in Singapore, and anywhere around the world, they must already report this. Some of you in audit firm. As an auditor, you must audit whether your client has reported IFRS S1. Because if the year started on January 24, the year must end on December 24. Then your audit firm must come and audit in 2025 the financial statements of 2024. All right. And you have to show this. Notice you don't need to report comparative. Comparative are not necessary. So what did we learn? Lesson 1. You learn that it is good to have comparative. What did I say? I say, see my lesson 1 framework. Lesson 1 framework, chapter number 2. Chapter 2. It is good to have comparability. If I don't have, doesn't mean that my financial statements are wrong. It is not wrong. So I want you to slowly understand why I teach you some standards first and then some standards later. Because the knowledge will flow. So how do you revise my lecture? Go to lesson 1. Go to lesson 2, 3, 4, 5. Don't skip the class, all right? So in this case, this is disclosure. No comparative, you are still correct. Understand? Because 2024 is the first year. You don't have to report 2023. This is the meaning. So no need to report 2023. You only report 2024 onwards. Do you see what's happening? If you're not sure, you must stop me. Because poor student, you're learning 29 accounting standard. 29 accounting standard, that's a lot. And different accounting standards, obviously, they do different things. So you're reporting all this. Now, what do we report? IFRS S1 still follows your faithful representation. Still follows the relevance. So this is the chapter 2 framework. Stay calm. Same as framework in chapter 2. Must have characteristic and also your comparability, verifiability, timeliness, understandability, all the same. So students say, wait, stop. I'm very good in my studies. You tell me, where is materiality? If you had asked me, where is materiality? I'll be very happy for you because you have very strong basic. Materiality is coming up. So let me come back to that. What do we report? We report both good news and bad news. Also report short-term, long-term, medium-term. So here, IFRS S1 shall report ST short-term, MT medium-term, LT long-term. If you're not sure, it's okay. Short-term, medium-term, long-term. So far all clear? Okay. So this one, I'll let you read. Example. If I have lost the use of water, I have lost the use of water, I am not sustainable. So I report bad news. For example, the entity, the company, have lost the use of water. Why? I'm a farmer. I am a farmer in Cambodia. All right. There are many provinces. I'm sure you know, like for example, Patapong province is famous for its rice. Agree? So that entity, as a farmer in Patapong province, and we have lost the use of water. My farming is no longer sustainable. So what did I say? I am no longer sustainable. Maybe in the long term. Short term, less than 1 year. Medium term, maybe 1 to 3 years, depending on industry. Long term can be more than 3, can be more than 5, depending on the industry. So, but generally, short term is less than 1 year. So I shall report under IFRS S1 that I'm no longer sustainable. I cannot continue farming. So I report bad news. I may also report good news. Both good news and bad news I must report. So you may also report on the government strategy, sustainability changes, all this is fine. Example 1. All right, let's look at example 1. You find out that your supplier do not follow international employment like child labor. For example, your supplier uses child labor. It is illegal to use child labor. Children are meant to go to school. Children are not meant to work in a factory. So if you realize that your supplier uses child labor, you shall stop. No offense, but in Europe, many clothing company, for example, Marks and Spencer, they have factories in Bangladesh. Bangladesh is a country somewhere in Asia near to the India side. So there's a Bangladesh. Clothing factory prosper in Bangladesh. And some sweatshop, Bangladesh factory, they use child labor. Okay, I hope you understand what I say, but if you don't understand what I say, let me try to show you child labor Bangladesh factory. Hopefully, yeah, and that's right, wrongly is fine. You see, it's very sad because garment factories, child labor, and if you are Marks and Spencer, Marks and Spencer, do you see, this is called Bangladesh. It is the country called Bangladesh. They have child labor. Children are meant to go to school, but the parents are so poor. The parents are not able to send the children to school. All right. So all these children, instead of going to school, they go to work in a factory, clothing factory. So many European retailers, they buy clothing from Bangladesh. So now, I'm not here to teach you sustainability. All right, I'm here to teach you good news and bad news. I used to teach corporate governance. So topics like that is always very easy to report for corporate governance. So let's come back. What's the good news? Your company has terminated an unethical supplier. What do? You shall apply IFRS S1 to disclose this is a good news. And I said to disclose this good news. So IFRS S1 shall disclose both good news and bad news. Example 2. You used to make a product, and this product is harmful to the environment. There's a greenhouse gas, harmful. So you close the entire factory. You discontinue a product that's highly pollutive. So yeah, it's a good news also. The company has terminated a highly pollutive, high carbon dioxide, highly pollutive product. And closed its factory. So this factory is harmful to the environment. I shut down because I love nature. I love Earth. I do not want it to be global warming. Again, I apply IFRS S1 to report good news and bad news. So it's not very difficult. Something new. So when you are an accountant, when you are an auditor, this is something that you have to pay attention to. It's something new, very, very new. Next one. What do you disclose on the screen? Business model, strategies, balance sheet, P&L. If there's a financial impact, you disclose. All right, so resilience. How are you able to endure changes by the government policy? If you notice, in the last 2 years, around you, there are many electric vehicles. You'll notice that, right? Why? Because many governments around the world, they are pushing for low pollution. And I'm not sure if you are aware, but in Singapore, other countries, I'm not very sure about the timeline, but Singapore will ban petrol vehicle in 2030. Do you see this? Singapore government will ban the import of petrol vehicle from 2030. Your vehicles in Singapore can be electric, can be hybrid, can be hydrogen, but no more petrol. So this is the Singapore government. This is the Singapore government way of protecting the environment. So if your company sells petrol, slowly the demand will drop. In order to remain sustainable and resilient, resilient means I can endure. I can endure changes in the environment for that resilience. What do? I apply charging stations in my I replace petrol kiosks with charging stations. You see the point? So in Singapore, some of the petrol kiosks, they start to offer high-speed charging, but that really doesn't pick up. So in Singapore, many petrol kiosks have started to include a mini-mart to show people come to my petrol station, charge your vehicle. In the meantime, go some grocery shopping. So this is being resilient to the environmental changes. So here, something that I can read. Because this is a lengthy accounting standard, finally, the last important part is your you shall report the same duration as your financial statement. So your IFRS report, 12 months accounting period. Then your IFRS S1 also report the same 12 months. How do I know all this? Because these are what has been tested in SBR. In the SBR examination, this came up. So if these are the ones that come up, I'll tell you because as FR, you pay attention to this. So not too difficult, right? Next one. Comparative, the rest is the same. And then, oh, I forget to tell you about materiality. Where is my materiality? Please wait a while for me. Because suddenly I remember, as you can see, we got relevance, faithful representation, everything, except for materiality. There. This is my materiality on the screen. Do you see materiality? Thank you. I did not forget materiality. It's just that IFRS S1 report materiality separately. So but stay calm. This is the same definition of materiality, same as the framework. Same definition of materiality as the framework. So is this really difficult? It's not. Do you have any question? I started talking a lot to explain to you the accounting standards. Then we turn to look at some article on page number 35. So this is an article published by ACCA. Please read this article. And then you'll be fine. So by reading this article, you'll understand what's going on. So, ladies and gentlemen, is there any questions at all? Don't be shy, right? If you have no questions, okay, quick summary. Where are you now? You learn the framework. Chapter 1 of the framework makes decision. Buy, wholesale, lend or don't lend money, vote yes or vote no. Chapter 1. Chapter 2 of the framework says there are 3 fundamental qualitative characteristics: relevance, materiality, faithful representation. There are 4 good to have characteristics: comparability, verifiability, understandability, as well as they say comparability already. Okay, let me say one more time. Comparability, understandability, verifiability, as well as, I think I forget one. Careless me. What was the other one? I mentioned 3, but I appear to forget about, timeliness. It was timeliness. Yeah, so then in your framework, still moving on to your summary, framework, chapter number 3, talk about going concern. Oh, thank you very much, Lai Hong. Thank you. Chapter 3 says, if your business is a going concern healthy, you shall recognize asset cost, liability at settlement value. All right. If it's no longer a going concern, asset must sell to settle liability, NRV, and settlement. Chapter 4, the framework defined. Chapter 5, recognize, and if you no longer meet, you de-recognize. Chapter 6, measure historical cost, present value, replacement cost, fair value. Chapter 7, discloses. Then you are an accountant. When you prepare financial statement, you follow IFRS 18. And I went on to talk about sustainability is something new. So now, I would like to measure the word framework. Chapter 6 shows the word fair value. And you have an accounting standard that measures fair value. All right, so where am I? Thank you for asking me. I'm now on page number 36. What am I doing? I tick one more. I tick one more. I tick one more. So this is your fair value measurement. Where does fair value come from? Fair value will come after the break. So we will now take a 15-minute break. You come back from the break, you will turn to page 35 and we do fair value. So the time at home is 7:17 p.m. to 7:32 p.m. There's a 15-minute break. So the class will end at 9 p.m. Then there will be a class participation quiz afterwards. So after the break, look forward to that and enjoy your break. I will see you later. If I have any questions, feel free to chat. Right, thank you and see you soon. So, ladies and gentlemen, welcome back. What have I done is I've done framework IFRS 18, IFRS S1. Now, we are going to learn the fair value. Why? Because there are historical cost model, there are fair value model, there are revaluation model, that you need to know what's the meaning of fair value. Okay, so the company shall apply IFRS 13 in order to measure fair value. You call FV, fair value. And then IAS 16, revaluation model. This is just an example, yeah. Revaluation model. And IAS 40, fair value model. They will use this fair value. So which one comes first? IFRS 13 comes first. What do? They give you the meaning of fair value. And then that IAS 16 will use the fair value in its revaluation model. IAS 40 will use the fair value in its fair value model. So which one comes first? Your 13 comes first. All clear so far? Good. So this is the definition of a fair value. When I enter is when I buy. Okay, when I enter is when I buy an asset or when I sell an asset. What's the keyword? When I acquire, when I assume. Meaning, I buy an asset. I enter into an asset. I buy an asset. When you pay, you will always pay at the fair value. As a buyer, what do you want? You want to pay as low a price as possible as a buyer. As a seller, what do you want? You want to sell at the price as high as possible. But what's the problem? Too low price, nobody will sell to you. Too high the price, nobody will buy from you. In the end, you have the market equilibrium price. It's a price between a willing buyer and a willing seller, the market equilibrium price. So you will debit your asset. You will credit the bank. And the value is at, of course, you guessed it, fair value. Then when you assume a liability, the English is very funny, right? You assume a liability. It means that I borrow loan at fair value. So this is the fair value, the amount of loan. So today's market price, today's interest rate, you borrow. I assume you have been paying attention to the interest rate at the banks in Cambodia. In 2022, 3 years ago, the interest rate was as high as 5-6% for your fixed deposit. But it has since dropped to about maybe 2-4%. It has been dropping. So the interest rate will follow the market. So you will debit bank and you will credit a liability. I assume a liability means I borrow money. So this is your fair value. This is your fair value. Okay, good. Exit price is the opposite of entry price. I settle a liability. I sell my asset. Okay, so here and here, two different things. I sell an asset. Like I said earlier, as the seller, you hope to sell as high a price as possible, but not possible. Why? Your buyer wouldn't pay you. So the buyer that will pay you and the winning price that you'll be selling is called the market price. On the other hand, you settle alone at the fair value, at the settlement value. So here you debit a liability and you will credit a bank. What do you call that? I settle. So far all clear? So fair value means I can enter, I can exit. Don't worry. Next one, expected cash flow. This is a FCF. That stands for a future cash flow. All right, so a fair value can also be a present value. You will take the future cash flow times 1 divided by 1 plus R. Do you recall lesson 1? Now you have to revise in order to catch up with me. So the present value can also become a fair value. So this is also possible. Next one. On page 36, what do we learn? The condition and the location. Basically, if you have good condition, like brand new, and if you have good location, like near the river side, you have high fair value. Make sense, right? Good. And if there's many restriction, if you buy this place, you cannot renovate. If you buy this place, you cannot make noise. If you buy this place, you must, many restrictions, you cannot sublet. So the more the restrictions, the lower the fair value. You see? So this is what we call restrictions, conditions, location. Now, the transaction must take place at the market. Now remember, IFRS 13, fair value, this standard. What does it say? It says the fair value says that the fair value, let me wait for this to finish saving. If you can see the small little dot, it is now saving. I need to save it occasionally so that it doesn't crash and then I lost everything. Okay, so it says that fair value actually come from an active market. Example, in Cambodia, there's a stock exchange market. Your stock exchange market is Exchange Square. It is quite near Camp Ed, right? Quite near Camp Ed, there's an Exchange Square. So Exchange Square is an active market for your stocks and your shares. There is companies that's listed in a Cambodia exchange. Make sense? Good. Therefore, it is an example for market. But what's the meaning of principal market? Principal market is the highest volume sold. Highest volume sold regardless if our company sell. All right. Example. Cambodia export rice. Cambodia sell rice to 3 countries. Cambodia sell rice to, of course, the local market. Cambodia sell rice to Indonesian market, which I showed you last week. Cambodia also sell rice to the Singapore market. All right, so your company sell to the Singapore market, but Singapore market very small. Cambodia also sell rice to Indonesian market, but the majority of Cambodia rice farmer, they sell to the local Cambodia market, but our company sells to the Singapore market. Then our principal market, according to IFRS 13, is the one that everybody sell. So every rice farmer will sell their rice to the Cambodia market. But our company sells to the Singapore market, the fair value that we take, we must follow the Cambodian market. Why? Every seller sell in Cambodia. So I will follow in the Cambodian market. The fair value in the Cambodian market is to take selling price minus the transport cost. That's the fair value of the principal market. Everyone clear? Okay, next one. When there is in absence of the principal market, for example, there's a lockdown. For example, there's a loss of market, like the tariff. US levy tariff, so we say, okay, I don't want to sell my product to US anymore because it's so expensive, nobody want to buy. So because of that tariff, I lost the US market. Because of the lockdown, I lost the Singapore market. Because of some political reason, I lost the Indonesian market, I lost the China market. Therefore, I cannot sell to Thailand, I cannot sell to Vietnam, I cannot sell to Cambodia. So which market that gives me the highest selling price is known as the most advantageous market. Now remember, the most advantageous market is the one that has the highest net selling price. Ready? So the principal market is not the same definition as your most advantageous market. You have a blue color box. On the screen, this blue color box will measure for you the most, oh, careless me, the box is not very nice, right? Better? My goodness. It's meant to work nicely. Okay. Even my edges are not sharp enough. Right, now better. So how many boxes are there on the screen? 2. Got difference? Yes. You will take selling price minus the transaction cost, like an agent fee, like a broker fee, like a commission fee, minus the delivery fee called the transport fee, to get only the most advantageous market. But once you determine the most advantageous market is market B, for example, market B, the formula for the most advantageous market and the principal market to find fair value are exactly the same. Selling price minus the transport cost. So in the end, you have 2 different formulas. The blue color formula is only to find which market is the most advantageous market. But this is not the formula to find fair value. This is the formula to find which is the most advantageous market. And then the fair value of both the principal, which is where everybody sells to, and the most advantageous market is to take selling price minus the transport only. So it's 2 very different. So what do you do now? I would need you to log into the Google Classroom for the participation, all right, for lesson number 2. Ladies and gentlemen, this is Google Classroom. Here, Google Classroom. Then you have a class participation. Do you see lesson 2? Click on this lesson 2, please. Thank you very much for 2 of you who have turned in. Thank you very much. If you click on this IFRS 13, you will find this. Can you please, based on what you just learned with me, try to find which is the principal market, and then also try to find which is the most advantageous market. Okay. The principal market, selling price. Then after that, try and find one more. Let me type that. After the principal market, you have to find the most advantageous market. Fair value is equals to same thing, selling price minus away the transport cost. So please try this. For I don't think you need too much of time. Maybe 5 minutes is good enough. So please try. If you have any question, you can chat with me. Otherwise, Google Classroom, try for 5 minutes. Oh yeah, it should be 5 minutes, should be 53. I added wrongly. So let me edit this. Can I edit this? Let me see. I think I cannot edit. So sorry about that. Update will be 7.48 to 7.53. Yep. Thank you. This question that you see is a SBR question. Two more minutes, please try. Thank you. Remember, it's not about whether you get the answer correct or you get the answer wrong. It is to participate. It's like I teach you something, we try something, then we see immediately if you get it correct or incorrect. This is called the learning process. Yeah, so Okay, my turn. My turn. Thank you very much for your try. So first of all, IFRS 13, measure fair value first priority, come from the principal market. Only when you don't have the principal market, you will use the most advantageous market. Like there's a lockdown, or due to some government tariff, you no longer want to sell to that market. It is no longer profitable. So market A, as you can see, have 10,000 units sold. That's the highest. But our company sell to market B of 700. This defines that market A is the principal market because it's the highest unit sold. Market A is the principal market. So the fair value of the principal market will be equals to SP, short form for selling price, is $15, you can see. So $15. Minus away the transport cost, short form for TPT, transport. The transport cost is $3. So the fair value in the principal market, 15 minus 3, thank you very much, you get $12. Right? Not so difficult. And only in absence of the principal market, like there's a lockdown, there's a government ban, you stop. Government say you cannot sell to this market. So because of political reasons, you need to use the highest selling price. So you take the selling price minus every cost. 15 minus 3 minus 2, selling price 10. 16 minus 3 minus 2, 11. 18 minus 3 minus 2, 13. So this will give you the highest selling price is market C. So market C is the MAM, most advantageous, most advantageous market. So the fair value of the most advantageous market is now taking the selling price of here, 18. Right, do you see 18? Minus only a transport cost of 3. So 18 minus of the TPT, transport cost of $3. So students say, wait, hang on, isn't that your most advantageous market? Fair value is $13. Look at the screen. I have $13, I got $15. So which one do I take? I go back to my lecture notes. In my note, red color box is the way I find fair value. I don't care if it's the principal market or the most advantageous market. Fair value only minus the transport cost. Only the transport cost. But look at the blue box on the top. This blue box at the top is for me to find which is the most advantageous market by minusing all costs from transaction and transportation. That is to find which is the one that gives me the highest net selling price. Because that one with the highest net selling price will be the most advantageous market. All right, so now that you understand the way to calculate, let me show you. All right, let me show you. This is your fair value, selling price minus the transport. This is your fair value, also selling price minus the transport. So 12 is correct, 15 is also correct. Fair value do not necessarily take the higher. No, not true. So what's your conclusion? Conclusion. your first priority, first choice, priority, first priority, fair value will come from the principal market, come to the principal market, which is your market A. If you ask me why, simple. Because it has the highest volume sold, regardless if our company sell or not. Highest volume sold, regardless if our company sells. So how much is the fair value? In this case, the fair value is $12. Fair value of $12 come from the principal market. Okay? Then so this is the absence, in absence of the principal market, then the fair value shall come from fair value $15. Fair value of $15 shall come from the most advantageous market. The market is C. Come from the most advantageous market C. All right? Why? because this market has the highest net selling price. So the market that's the highest net selling price will become the most advantageous market. Which is the first priority? Principal. When you are not able to access to the principal market, then the most advantageous market is the one that is important. So I save it, and I would like to print it so that you will be able to refer. And I want to print this into a A4 size portrait. Yeah, so it is easy for to keep. You know, this is okay, export. It should be in my download folder. This is my download folder. Then I want to move to my SD card under ChemEd. CE ChemEd. Then I go to our December exam, December 25 exam. I'm teaching 3 papers at ChemEd. So now we're FR. I would call this JD 1.2. Then I will come here and I need to rename. Okay. Rename. Financial reporting. June and December. Text is number lesson 2.1. Lesson 2.1. IFRS 13 on the fair value. So yeah, this is something that you can take a look at. I also upload now, so at least you understand how I talk, or rather how I teach. Hey, yeah, careless me, I should have not closed it. Let me come here. Then I'm gonna log into ChemEd. Then this is our class, right? Then this is me. Yeah, I accidentally closed this page. I'm so sorry. And I got lesson 2. And then I want to edit lesson 2. So this is just how I communicate with you, you know. It is important that you go to the Google Classroom and you start to download materials. So it's been uploaded. It's a very tiny file. Then I save. So yes, between listening and copying, obviously your listening is important. And thank you for turning in, right? If you're watching this, thank you. So copying, I'll be uploading information like this, just like that, as you can see, fair value. So if you have question, you can always chat with me because I will put the box here. Sometimes when I do something else, the box will disappear, but eventually I will always check the box. So this is when you look at your lesson 2.1 for this fair value measurement. If there's any question, you stop me. So why am I learning this? Because the fair value comes from the active market. And this is your active market. Most advantageous market, principal market. Turn to page number 38. What do you have here is the valuation. What do you mean by valuation? How do you measure? So this is how to measure fair value. All right, the fair value of a new word to you is called non-financial asset. What is a non-financial asset? Okay, let me take some time to explain this. A non-financial asset, FA. If you're not sure what's a FA, FA stands for financial asset. Non-financial asset will include property, plant, equipment. All right, include your intangible asset. Maybe include also your investment property, which is not the right to receive cash. If it is the right to receive cash, it is a financial asset, such as your cash, such as your bank, such as your loan, receivable. So these are maybe your bank deposit also get the same idea. These are your financial asset with the right to receive money. Are they the same thing? No, they're not the same thing. So a non-financial asset, basically property, plant, equipment. And you apply IFRS 13 to measure the fair value of a non-financial asset. Property, plant, equipment, intangible asset, investment property. PPE, property, plant, equipment. IA, intangible assets. IP, investment property. FA, financial asset. Cash, bank, loan, receivable. So I use some short form because it's pretty long, the words, yeah? Which is correct? Well, method 1, 2, 3, and 4 are all correct. What did I say? All. 4 methods to measure fair value, they are all correct. It's just like sometimes when you learn costing, absorption costing is correct. Activity-based costing is correct. Life cycle costing is correct. Target costing is correct. Marginal costing is correct. Got so many ways to measure costs. Which is correct? Poor student must read the question carefully in order to apply the correct method. In order to apply the correct method. So you see what's going on? Okay. So now we come back. What's called the market approach? If you're using the market approach, you no need to calculate fair value. No need. Why do you do that? You simply take the market price as your fair value. Example, your gold, your oil gold price. Example, your oil price. Example, your share price. Since when you calculate gold price? Since never. Since when you calculate the currency exchange rate? Since never. Because it's always there. What do? You simply take the value and you times the quantity. Simply. Next one. Let's go to cost approach. Today's price to buy the same new asset, to buy the same asset, but the new one, yeah. Today's replacement cost is the fair value. If you need to replace, but if you are not going to replace the income, it can be the fair value is the present value. Fair value is also the present value. So this is the present value of inflow. This is the present value for net cash flow. Net inflow or outflow. So it doesn't matter. So it can be net inflow, net outflow. So depending on the question. Inflow is correct, outflow is also correct. It depends. All right, so all clear? Good. Now that if you are ready, we turn again to look at page 39. So this is consistent. Page 39, right, is consistent with next lesson. You will see me again on Monday night. Coming Monday night, 21st of July. Consistent with IAS 16, the revaluation model. Right? So this is now you're laying a foundation for the next lesson. You're like last lesson, earlier Monday, this week, you lay the foundation for today, lesson 2. Lesson 2 today, you lay the foundation for lesson 3 come Monday night. So let me explain. Consistent with IAS 16 revaluation model. For example, I have a farm land. Historical cost was 10 million. All right. If I change the farmland, maybe to grow rice, yeah, change to home use. I change to build condominium, residential use. I can earn fair value 12 million. Or if I change it to commercial use, I build shopping center, I build some factories, commercial use. Commercial use, fair value is 11 million. For example, yeah, just for example. So there are quite a few users. IFRS 13 says it must be highest and best use, regardless of your intention. So IFRS 13 shall value your farmland, IAS 16 farmland, at highest and best use value 12 million, highest and best use value, and it's regardless of your intention. Regardless of intention, meaning it does not matter. Do you wish to sell to become residential use or commercial use? It does not matter. But you follow the highest market price. Next week, Monday, you will see me for a revaluation model IAS 16. So it do not matter if you don't want to use If you don't want to sell your land, as long as your land has a higher value, that is your fair value. Even if you don't want to sell your land. Clear? Okay. So this is the meaning of highest and best use value. Next one. We go back to lesson 1. What did I say? Lesson 1 earlier this week, Monday. You saw me for the very first lesson, and we learned the framework. On this framework, you learn with me chapter 6. Lesson 1, you learn with me chapter 6. In chapter 6, you learn that there is a chapter 2, verifiability. Not chapter 6, so sorry. Chapter 2, you learn with me verifiability. What's called verifiability? Good to have invoices. Chapter 2, good to have invoices as an evidence. Now look at my handwriting. IFRS 13, level 3 say, the director's own estimate without invoices. The director's own estimate without invoices, they are still acceptable. Do you see that? The director's own estimate don't have invoices statement as the evidence, right? Acceptable? Yes, still acceptable. So, ladies and gentlemen, every lesson you see me, I lay you a foundation. Now this is called fair value hierarchy, the priority. You are going to learn what's level 1, 2, 3, the same as that. So this is your priority. This is also your reliability ranking of fair value. Since there are so many market, so which market, which fair value, which use value is the most reliable? Level 1, okay, level 1 is an active market for exactly the same asset. This is the most reliable. What did I say? The most reliable fair value come from the active market price. Active market price of the identical, exactly the same asset. What do you mean? Example, gold. Example, currency. Example, oil, commodities. If you have 1 gram of gold, the same gram of gold and my same gram of gold is the same price. If $1 US, your US dollar in Cambodia right now, my US dollar in Singapore right now has the same price because it's the same US dollar. And there's only one exchange rate. Your 1 barrel of oil and my 1 barrel of oil is the same commodity. We have the same price. However, level 2 is reliable, but not the most reliable. This is a reliable fair value come from an active market. Active market adjusted market price. Adjusted market price of your similar, not identical, of your similar asset. What do you mean by a similar asset? It says here, quoted price of a similar asset. Not identical, but similar. So I don't understand what does that mean. Example. Houses, properties are similar but not identical, right? If your property at 10 story, level 10 story, can sell for maybe $1 million US, just an example. Can be more, can be less, doesn't matter, okay? Then our property on the same building, that means the same floor area, at maybe the 8th floor, 8th story, can sell for maybe 90% of 1 million. This is called the adjusted price. Why? Although you have a property in the same building, the same square meter, but different level, the price is similar. Why? Level 10, level 8 is not too greatly different. But level 2 and level 10 is far away. Then the discount may be 50%, maybe 60%. You get the idea? What do you mean by similar? Properties are never identical. See, because I teach in both Singapore and Cambodia, I always tell my students that Singapore is hot. It's not the same as Cambodia hot. Singapore is hot like when you steam a fish in a wok. You know, when you steam a fish in a wok, it is very hot. And this is very hot and it's very wet. Welcome to Singapore, hot and wet. So in Cambodia, it's also hot in Cambodia. It's like when you bake a pizza in the oven, hot, but hot and dry. So this is when you bake a pizza in the oven, hot or not hot, so hot they can melt the cheese, but you don't feel it's very dry. So this is the same weather as Cambodia. So when I walk around Phnom Penh, yeah, sometimes I walk to school, you know, I don't, because my hotel is at the riverside, sometimes I can just walk from the hotel, walk to Camp Ed. So I don't take a Grab sometimes because it is hot, but it is dry. I don't sweat. But in Singapore, the first thing you do after you shower, you already sweat. No, seriously. The first thing you do in Singapore after you shower, you sweat because it's so humid. The air is so wet. Yeah, so you sweat very easily. So Singapore is hot, Canberra is hot. What has it to do with our lesson? Yeah, good question. Properties in Singapore, the wall get moldy easily. What did I say? Properties in Singapore, the wall get moldy very easily. Moldy wall. Yeah, moldy wall. In Singapore, things like that happen very easily. You don't see a lot of moldy wall in Cambodia, you don't. Unless you don't open the window, keep on turn aircon all the time. Otherwise, Singapore, you can see things getting moldy because it's so wet. So when you buy a property in Singapore, you should buy a property that have sunlight that shines into the house. But when you go to Cambodia, maybe if your house got no sunlight, it is not so humid. So for that reason, maybe on the same floor, one unit got sun, one unit got no sun, the price is also different. You see? But your neighbor house on the 10th floor and your house also on the 10th floor, one got sun, one got no sun, the price is about the same. See the point? So in Cambodia, when I asked students in CAMED before, students in CAMED always tell me it is good to buy a property with sunlight. And you are right, very smart. You know why? Because if you buy a property without a sunlight, yeah, you can never create sunlight. But if you buy a property with sunlight and you don't like the sunlight, what do? You can add curtain, you can add blind, you can add something to block the sunlight. But if your house got no sunlight, there's nothing you can do to bring sunlight. You cannot say, I knock another window. It doesn't work that way, right? So that's why properties is a good example of a similar asset. Commodities, gold, currency, oil are a good example of an identical asset. So we understand the differences, right? But level 3, you have no invoices, but you still allow. Why? IFRS 13 allow fair level 3. Let me add there level 3. Level 3, allow. Level 3, allow. Fair value without invoices. Yeah, as evidence. That means to say the it as IE plus IE stands for it est in Latin. Not English, this is Latin. Actually means that is in English. It means that is in English. Two different things. So if you're ready, now your director's own estimates are allowed. So what am I doing? I am a professional accountant. My name is Roy. I'm a professional accountant. I'm a CA, I'm an FCCA. So because I'm a professional accountant, I summarize accounting standards so that you know what's important. So come to my class, there's two things to do. We call it knowledge. You listen to a teacher talk, you get knowledge. Then the next thing is try. So ladies and gentlemen, page number 40. After you hear me talk for like maybe more than half an hour, good, try. It's so easy, try. Please. Any suggestions, anyone? Take one more minute to try, please. B. Lai Hong says B. Now, my turn. Congratulations, you are right. Which is not considered, not acceptable, not allowed. So acceptable, allowed, acceptable as fair value, question mark. So you say the characteristic, of course, this is allowed. Why? If you have good condition and location, it's called characteristic. You will have a high fair value, vice versa. So this is correct. The present value is actually no. But you say, right, wait. In your class, you teach me that present value is one of the, in fact, it's two methods that's allowed. So why you say it is not? Be careful. The question is asking for to consider, not to measure. You see, not to measure. B is not considered, not acceptable, not considered. Why? Because if an active market exists to give fair value, the company do not need to calculate the gold price. All right? Wait. Do not need to calculate the present value of my carelessness. Don't need to calculate the present value. Right? What do? The company simply take the fair value from the active market. And you do not need to calculate any present value. For example, I just take the gold price, the oil price, the currency price, finish. Must I calculate present value? No need. I'm not saying that present value is wrong. I'm just saying that it is not considered as a fair value. Not considered as a fair value. You see, it doesn't affect the fair value. So this is tricky, but I'm glad Lai Hong got it correct. Thank you very much for your participation. Well done. Okay, now, principal most advantageous market obviously consider. Because why? Fair value in either of the market, principal most advantageous minus only the, is equals to the selling price, minus only the transport costs. In either of both markets, you get the same fair value. Highest and best use value is also definitely allowed. Highest and best use value. And this is regardless of your intention. It is also considered a fair value. So this is regardless of your intention. Don't care whether you want or you don't want to sell. The highest and best use value will be your fair value. So question? No? Okay. Where am I? I have finished yet another standard. You have ticked IFRS 13 with me because we finished. And so far, 3 plus 1, 4 among 29. The next tick is at 21. The last standard in chapter 1 is IS 21. So let me put a small tick here on 21. Then it's safe. Every time you see me, you will learn at least one standard. Why? You have 20 education lessons with me, 5 revision lessons with me. So 25 lessons of 3 hours each, you got 75 hours with me. And we got 29 standards to learn. So 20 lessons to learn 29 on the average. Every lesson you learn a little bit more than 1. You see? So this is 21 when there's a currency. To students, this is easy, especially when you are a student in Cambodia. Because in Cambodia, 2 currency is very active. Your local Khmer Rio, I'm sure that in your wallet, in your money bag, in your handbag, in your purse, you will have local currency Khmer Rio. I'm sure you also have another US dollar, another currency. So you have exchange in 2 different currency. But when I teach in Singapore, we only use 1 Singapore dollar. When you come to Singapore and visit for a holiday, for example, you do not bring Khmer Rio. You do not bring US dollar. So the local market in Singapore, we use only the Singapore dollar. You see? So you have to exchange. Therefore, when is IAS 21 applicable? You apply 21 when you buy or sell goods in a foreign currency. When you borrow or lend money in a foreign currency. When you sell, buy asset in a foreign currency, also can be a liability to settle or to owe in a foreign currency. So any transaction with a foreign currency, you apply IAS 21. Easy? Not so bad. Okay, let's look at some definition. Closing rate is a year-end spot rate. Year-end spot rate. What did I say? Year-end spot rate. Spot rate is the date of transaction. The spot rate is at the date of transaction. So this is the spot rate is at the date of transaction. You call that the spot rate. Next one is called the functional currency. It's your trading currency. So, for example, companies trade in US dollar in Cambodia. Agree? You pay your salary. I mean, you receive your salary in Khmer Rouge. No, you receive your salary in US dollar. You deposit your US dollar in the bank. You withdraw in Khmer Rouge. Make sense? Yes. So this is called a functional currency. It's simply the trading currency. Don't care where you are in the world, the moment you buy and sell oil, you pay in US dollar. Don't care where you are in the world, the moment you buy and sell Bitcoin, you also pay in US dollar. Make sense to you? Yes. What's called presentation currency? Because your company is incorporated in Cambodia, your reporting currency is the presentation currency. Your reporting currency is different from your functional currency. So on the screen, companies report in Khmer Rouge. All right. It is called the presentation currency. This is your presentation currency. So do you see the differences? Good. When you are studying ACCA, the functional currency is sterling pound. Yes, although you pay in US dollar, but they convert into sterling pound because ACCA says anywhere you are in the world, you must pay in sterling pound. And that's the functional currency. But I present in Khmer Rouge because I'm a registered company in Cambodia. You see differences? Good. So monetary are like financial assets. Currency unit just called CU. Foreign operations, you may have a foreign subsidiary, foreign associate, foreign joint venture. This you don't really study in FR. You wait until SBR, you have a foreign subsidiary. So here, any foreign subsidiary, associate, joint venture, you have to see in your master degree, strategic business reporting, and not in our paper called financial reporting. So when I'm teaching SBR, I have to teach my students on chapter number 8. No, chapter 7, because the last chapter is chapter 8. On chapter 7, foreign subsidiary. So their stress level very high. So your stress level not high. So this can be a foreign financial asset. That's all. So this is just a foreign financial asset of maybe 1% to 19% share. Right. So this is your shares between 1% to 19% shareholding. So we'll learn more about this shareholding, not today. Today's not the point. The point today is what is the exchange rate? See, what's the exchange rate? Okay. So now I come here and you have the recognition. You always apply the matching principle. Recognition, you always apply the matching principle. What is called the matching principle? Very simple. If your assets and liability are balance sheet item, you apply closing rate. If your income expenses from P&L, you apply the spot rate. So what did I say? You use IAS 21 shall apply the year-end closing rate, CR, this is called closing rate, to balance sheet item, statements of financial position items, called assets and liability, always. Then IAS 21 also apply your spot rate to P and L item, P&L items. But there's a problem. There are too many rates. For practical reason, we always use the average rate, right? So for P and L items, in the exam, you may use an average rate. It's called AR for stable exchange. For stable exchange rate. A good example is Khmer Ringgit and US dollar. 4,000 Riel is $1 in most of the places. Maybe in hotels or some places it's different. But in most places, I'm sure you have better knowledge than me. In Cambodia, in most places, except for hotels and some shopping, $1, the shops on the street always take the average rate of 4,000 Riel to be $1. But I'm so sorry, that may not necessarily be the actual currency. Why? This is your KH, that Khmer Ringgit to US dollar. Actually, I should put it the other way around. Let me delete this. US dollar to Khmer Ringgit. I like that better. US dollar to Khmer Ringgit. What's this? Let's look at the maximum. It fluctuates. Sometimes a little bit higher, like 4,002, some a little bit lower. It is not exactly 4,000, right? But do we care? No. Companies, shops, 7-Eleven, convenience shops, your noodle store, they always take 4,000 to $1. So what do? You take your salary from Khmer Ringgit, because your company backing your salary in US dollar, right? You go to a bank and withdraw in Khmer Ringgit. Or you take US dollar, go to the money changer, exchange in Khmer Ringgit, then you spend. You will save a little bit of money there. Yes or no? Yeah. So, but do people really care? No, why not? Because it is about stable. About stable. So this is what we mean by when you have a currency that's quite stable, you use an average rate. Clear? Okay. Matching principle I just mentioned. If it's a balance sheet item, match to the balance sheet. P&L item, match to a P&L. So this is called a balance sheet item. You always match back to the balance sheets. A P and L item, like income expenses, right? You also match back to the P and L. So which is correct? Well, both are correct. Both are correct. Now, a little bit more. You call that conversion. You call it translation. Are they the same thing? No, they're not the same thing. But you don't really hear this anymore. To convert is to settle, is to receive. So maybe a workplace, you call this to settle. It as your, what's that word? Realize. It as to realize. This is called realize. But you don't really see the word realize in the accounting standard. But at your workplace, you hear the word realize and unrealized. Okay, this is called realize. Translation, it is not yet settled, not yet paid. That means you say it is unrealized. It is called unrealized. But I must remind you, we do not use the word realized or unrealized in IAS 21. At your workplace, can use word realize, you can use word unrealized, but not for us. For example, the Singapore company buy from a Cambodia company, like maybe rice, maybe food produce of 100,000. Exchange rate is $1 to 1.2 Singapore dollar. So the Singapore company is the buyer, debit purchases credit payable. And it has been settled, it's been realized. It's been settled and realized, you will debit your bank. No, you credit your bank when you pay. Exchange rate is 1.3. So when you pay 1.3, it is 130,000. To settle the amount of 100 US thousand dollar, you settle your liability, but you pay more. Not because you buy more, but the Singapore dollar weakened, the US dollar strengthened, we suffer a loss. What do I call that? Conversion. On the other hand, translation is another word called not yet settled, unrealized. And we say, this is bank loan. We take a bank loan from US dollar and we debit bank credit liability in Singapore dollar. Exchange rate 1.2. At year end, not yet paid, unrealized, not yet settled. And the exchange rate is now 1.4. So I owe them more money, not because I borrow more. The loan is still 100,000, but I must transact the closing rates, which is 1.4. So it will show as if I owe them more money, not because I borrow more. Remember that, please. So currency weaken, my liability increases, I recognize as an expense. As exchange loss, interest expenses is fine. Question? No? So this is exchange rate. Students in Cambodia very strong in exchange rate because you handle this a lot. Okay, let's try question 1. Maybe you can take 3 minutes to try question 1. You have to pay attention to the keyword. Purchases and sales are P&L item. So these are called P&L item. I will use either the spot rate or I will use the average rate. I cannot use the closing rate. Yeah. So Tiam Heng say is D. And you are right. Let me explain. The rate and the date of transaction. So yes, you can use a spot rate is correct. The rate at the beginning, no. Why not? Because not all P&L items happen at the same date. Your P and L are over 12 months. Sales is not at day 1, at the first day. You cannot say all my sales, all my purchases for the whole year all happen on the one day. It doesn't work. So I cannot use the one that's at the beginning. So here, let me push it higher. This is called spot rate. Is allowed for your P&L item. Spot rate is allowed for P&L item. So this one, let me push it higher. I want to write there 4. P&L item. Strange. I cannot write the stroke here. Okay, let me write it again. For P&L item, this is yes is allowed. This one no. Because not all sales is at the one day. For average rate, yes. So P and L item also can use the AR average rate. But the rate at the end of the year also no. Why? Because you still assume not all income and not all expenses are made on last day of the year. Only if you assume that all are last day of the year, they can use the average rate, or you can use the year closing rate. So thank you very much. Tian Hing is correct. Answer is D. Thank you. You are right. Are we done? Not yet. Not yet. We have an old question. So this old question is about translation of a purchase. Point 1, of a sales of an investment property. Why? You buy at 8 million euro and you are in the dollars. So this is a foreign purchase. It is still outstanding. Still outstanding. That means it's called not yet settled. You buy on July, you still owe at October. When you buy at July, this is called the spot rate. This is called your closing rate. So 8 million when you buy is at 1.6. Still outstanding, 8 million still owing by 1.3. So I want to take you to the right here. What's that page? Over here, I will add in one page. Just a moment, please. Let me add a page for you. SD card can add last term. Then I have a FR. Then I go to lesson 2. Then I come and find for you this page. Okay, mission. So over here, just a moment, please. Let me copy this page and then let me paste this page. Yeah, so you can see this. Okay, so it's an old question. Listen to my explanation and you'll be fine. On the screen, I have a purchases of euro at a rate of 1.6. So debit purchases, credit payable. So later when I upload this, you'll take the answer. So please don't worry. And the rate is 1.6 over 8 million at 1.65 million dollars, as you can see. Do you pay yet? Not yet. At the year end, you still owe them 8, but the rate is 1.3. How did you know? The year end rate is 1.3. So $8 million at 1.3, you owe them 6.2. From 5, you owe them 6.2. No, you did not buy more. You still owe them the same 8. But because our dollar has weakened, we owe them more. You call this a exchange loss. More liability is bad. Exchange loss. Now, let's look at point 2. Point 2, not difficult. There's only one value of 4 million euro and you have actually received payment, you call this settled. Settled is called translated. When you settled, it's called converted. So we come here, please. Same thing. When you sell, debit accounts receivable, credit sales, not yet settled during the date, credit sales. But at the year end, it was settled. When it's settled, you receive money in the bank at the rate of 1.3. So customer owe you 2.5, but you receive 3.1. Is it because you sell more to them? No, you did not. You still reduce your debtor 2.5, but you increase bank 3.1. Differences is called exchange gain. You receive more asset. Good news, exchange gain. Put to the cost of sales. So student asked me, stop. Exchange differences from the purchases go to cost of sales, but how come exchange differences from the sales also go to cost of sales? You can also put to sales, it doesn't matter. So if you put to sales or if you put to cost of sales, answer still the same. As long as it affect your gross profit, you are fine. It do not matter if you put to the sales or you put to the cost of sales for exchange on sales and purchases, because both of them also affect your gross profit. You see the point? Finally, you buy investment property, not 5. You just buy investment property. And euro 28 at the date of purchase of November, year end, it is 24. So your fair value has dropped and your currency has also weakened. So two impact. When I buy investment property, I increase asset, reduce bank. At the year end, my asset drop. Charge it to the fair value, gain and loss. All right, so this is called your IAS 40. Other gain, other losses all come here. Not sales, not other income, but your impairment. You come here, 0.8. What is 0.8? Allow me to please scroll to note number 8. This is note 5, 6, 8 is over here. You see note number 8? You have a investment property, fair value gain, fair value loss. So you report something similar onto the P&L. So this is not about investment property, this is about exchange calculation. All right, so I'm going to print this, and the next time that you see me is on 21st, right? Let me check my calendar. So today is the 19th. It's a Saturday. 21st, you have lesson 3 with me. So this is your asset. Come here. It is lesson 3. So this is your financial reporting. Lesson 3. It will happen on 21st July 2025. This is going to be a Monday. Again, 6 to 9 p.m. Monday night. So you will see me most of the time on a Monday. Occasionally Saturday. So what I'm going to do is I'm going to print all these materials for you so you can understand what's going on. There, this is lesson 2. So I will print into PDF as lesson 2 in my SD card. So this is 25 FR. I will save it here and I will call it number 2, text 2. So lesson 2 has just ended. After the computer has finished saving, I'll upload this. You can exit the class if you want to. If you have questions, you can also ask me your questions, if any. Then I am going to upload this onto the Google Classroom. Please download. All right, give me a moment more. It's still loading. It's still saving. You can see the 4 little dots, which is represented, is still saving. Yeah, saving is important before it crashes, you know. Done saving. So I will come to my Google Classroom. Right, yeah, you can exit now. Thank you so much. Then this is our Google Classroom. And this is lesson 2. Upload. Lesson 2. Done. Okay. So again, it is being uploaded, all the material. So ladies and gentlemen, thank you very much for your time and attention. I wish you a good evening. Have a good night's sleep and rest. I will see you on Monday. So thank you very much for your time and attention. See you very soon. Good night and goodbye.